It's late. Maybe it's 11:30. Maybe it's midnight. Your partner's asleep. The house is quiet. But you're lying there staring at your phone, and you've got the Fidelity app open, or Vanguard, or Schwab, whatever it is. And you're looking at your index fund, the one everyone told you to buy, the one that's supposed to be the smart, boring, set-it-and-forget-it move. And for some reason, tonight, you can't stop second-guessing it. Maybe you're in the S&P 500 because your coworker swore by it, or you saw it on Reddit 3 years ago and it just sounded right. Or maybe you specifically picked a global fund because you thought, I don't want all my eggs in one country. And now you're not sleeping because you've been seeing headlines about the dollar weakening, or about tech stocks being overvalued, or about Europe and Asia starting to close the gap, and you're wondering if you made the wrong call. Here's what I want you to know right now. That feeling?
That low-grade financial anxiety buzzing at midnight? That's not stupidity. That's what happens when you make an important decision without a real framework. You just pick something and hope for the best. Most people do. Tonight, we fix that uncertainty. For good. Let's start by being really honest about how most Americans actually pick their index funds. You didn't do months of research. You didn't build a spreadsheet comparing CAPE ratios across asset classes. What actually happened, and I'm not judging you here, I'm describing literally millions of people, is one of these 5 things. 1. Someone told you. A coworker, a parent, a guy in a Facebook group. Just put it all in VOO, bro. Okay, done. VOO it is. 2. Your brokerage's app pushed you toward it. Robinhood's most popular list. Fidelity's suggested funds page. You picked the thing at the top because it seemed like it was the right answer. 3. You Googled best index fund and every single article said S&P 500, so you figured the internet had decided. 4. You heard global diversification in a podcast, thought it sounded sophisticated, and bought VXS or VT without fully understanding what was in it. Or 5, and this is the most common, you did a mix of all 4 and ended up with a portfolio that even you can't fully explain. And look, here's the thing. None of those are crazy decisions. The S&P 500 has an absolutely legendary track record. A global fund has a real philosophical argument behind it. These are both legitimate choices made by serious investors. The problem isn't what you picked. The problem is that you probably can't answer these 3 questions right now. Number 1, what exactly is in the fund you own? Number 2, how correlated are these 2 options really? Meaning if you own both, are you actually diversified at all? Or are you basically just doubling down on the same stuff? And number 3, what does the data actually suggest about forward-looking returns in 2026, not just what worked in the past? If you can't answer those 3 questions, you don't really have a strategy. You have a hope, and hope is a terrible portfolio manager. Let me put some numbers to this so it stops being abstract. As of early 2026, the S&P 500 is still heavily concentrated. The top 10 holdings, the Apples, the Microsofts, the Nvidias, the Amazons, account for roughly 35% of the entire index. 1/3 of your diversified index fund is essentially 10 companies. That's not bad, necessarily. Those are extraordinary companies, but you should know that's what you own. A total world fund, something like VT, Vanguard's Total World Stock ETF, is different. You own about 9,000 companies across 50-something countries. The US still makes up roughly 60 to 65% of that fund, which means when you own a global fund, you are still majority American stocks. You are not equally spreading your bets across the planet. You are mostly betting on America with a significant international sleeve attached. And here's the overlap question that nobody talks about enough. If you own the S&P 500 and a global fund, you are double counting a massive portion of your portfolio. You're not as diversified as you think. You're like someone who ordered 2 different pizzas and didn't realize they both came with the same toppings. Now add the 2026 context. Valuations, currency dynamics, geopolitical shifts, the AI build-out that's either going to justify these tech multiples or eventually correct hard. We are not in a normal environment. The decisions you make right now matter more than they would in a boring, stable market. So you've got a real problem on your hands, and it's not unsolvable. But we need to make you feel exactly how sharp the edges of this problem are before we hand you the answer. So let's do that. I want to tell you about two investors. Neither of them are dumb. Both of them made reasonable decisions. Both of them paid for it. The first investor, let's call him Marcus, went 100% S&P 500 starting in the year 2000, right at the peak of the dot-com boom. Now, Marcus wasn't reckless. He'd read the same Bogle books you've read. He knew index investing beat active management. He did everything right. And then from 2000 to 2010, the S&P 500 produced essentially zero total returns over the decade, sometimes called the lost decade. Meanwhile, international developed markets, Europe, Japan, the rest, significantly outperformed during stretches of that period. Marcus's 100% S&P 500 conviction left him watching a decade of his prime earning years produce almost nothing. He stayed the course, which was the right call, eventually. But he had no cushion, no international exposure, nothing to smooth the ride. Now, meet the second investor. Let's call her Dana. Dana is smart. Dana read about global diversification in 2010. She looked at the previous decade, saw that international stocks had done better, and decided to go heavy global. She put 60% in international funds and 40% in US stocks. Very reasonable allocation, honestly. There's real academic support for it. And then from 2010 to 2020, the US stock market absolutely obliterated international markets. The S&P 500 compounded at roughly 13 to 14% annualized over that decade. International developed markets did roughly 5 to 6%. Emerging markets were even worse. Dana's globally diversified portfolio lagged an all-US portfolio by enormous amounts over that decade. Both Marcus and Dana did things that were intellectually defensible. Both of them paid a real price. Now, and this is where I want you to lean in, what is the 2026 version of this risk? Here's the honest answer. The risk is concentrated on the S&P 500 side right now, more than it has been in a long time. The cyclically adjusted price-to-earnings ratio, the CAPE ratio, which smooths out earnings over a decade, for U.S. stocks in early 2026 is sitting well above its historical average. We're talking numbers in the high 20s to low 30s, depending on the day. Historically, when you buy U.S. stocks at these valuations, your 10-year forward returns tend to be lower than average, not zero, not catastrophic, but lower. Meanwhile, international developed markets, Europe, the UK, Japan, are trading at significantly cheaper valuations. CAPE ratios in the low to mid-teens in many cases. Emerging markets are cheaper still. This valuation gap is real, and it's the widest it's been in years. Does that mean international stocks are about to go on a tear? I'm not going to tell you that because nobody knows. Cheap stocks can stay cheap for a long time. Japan was cheap for decades. Valuations are a terrible short-term market timing tool, but for long-term expected returns, they matter a lot. Then there's the dollar. The US dollar has been historically strong for much of the past decade. When the dollar is strong, international investments look worse to American investors because the returns get eaten up by currency conversion. If the dollar weakens over the next 5 to 10 years, and some serious economists think that's likely given the fiscal trajectory of the US, that headwind becomes a tailwind for international stocks. Suddenly, your German or Japanese holdings look a lot better in dollar terms. And then there's the concentration issue I mentioned earlier. The S&P 500 right now is more concentrated in a handful of mega-cap tech and AI names than it has been in modern history. More concentrated than the dot-com era. in some measures. Now, those companies might be worth every penny of those valuations. AI might really be the productivity revolution everyone says it is. Microsoft and Apple and Nvidia might be the engines of the next decade. That is genuinely possible. But you should understand what you're betting on when you go 100% S&P 500. You are making a significant implicit bet that American mega-cap technology companies will continue to dominate global markets. That is not a crazy bet. It might be the right bet, but you should know you're making it. The psychological cost of not having conviction in your own portfolio is something people don't talk about enough. You will panic at some point. The market will drop 20 or 30% at some point. It always does. And if you don't understand why you own what you own, you will sell. And selling at the bottom is the single most wealth-destroying thing a retail investor can do. The number one job of your portfolio is to be something you can hold through a crisis. If you're second-guessing it at midnight on a normal Tuesday, what are you going to do when markets are actually falling? That's the real cost of staying confused. It's not just the theoretical return differential. It's the behavioral cost of owning something you can't explain. Okay, let's fix this. I'm going to break this down into 4 things. What you actually own in each fund, what the valuation data says, what the research actually supports, and then a tiered recommendation based on where you are in your investing life. What is the S&P 500 fund? When you buy an S&P 500 index fund, VOO from Vanguard, SPY from State Street, FXAIX from Fidelity, you are buying a slice of 500 of the largest publicly traded companies in the United States. These companies are selected by a committee at S&P Global. They're weighted by market capitalization, meaning bigger companies get more of your money. Right now, in 2026, that means roughly 30 to 35% of your money goes into 10 companies. The rest is spread across the other 490. You get broad exposure to the American economy, healthcare, financials, consumer staples, energy, industrials, but you're heavily tilted toward technology and communication services, which together make up something close to 40% of the index. You are also, by definition, investing only in large-cap U.S. companies. No small caps, no international exposure, no emerging markets, pure American large-cap equity. Expense ratios on the big S&P 500 funds are essentially free now. VOO is 0.03%, FXAIX is 0.015%. The cost of ownership is negligible. What is a total world global fund? When you buy something like VT, Vanguard's Total World Stock ETF, you're buying roughly 9,000 companies across the entire investable global equity market. As of 2026, that's approximately 62 to 65% US stocks, 25% international developed markets, and 10% emerging markets. Those percentages shift as market caps change globally. You own companies in the UK, Japan, Germany, France, Canada, Australia, Taiwan, South Korea, China, India, Brazil. You own Samsung and ASML and Nestle and Toyota alongside your Apple and Microsoft. The expense ratio on VT is 0.07%, still basically nothing. What you're getting with a global fund is automatic rebalancing between US and international as market caps shift. If international markets start to outperform, the fund naturally tilts that way over time. You don't have to make a decision, it's handled. The overlap reality. Here's the thing that makes this comparison more nuanced than people realize. Because VT is 60+% US stocks, the correlation between the S&P 500 and a global fund is very high. We're talking correlations in the 0.95 to 0.97 range. They move together almost all the time. So if you own both, as some people do, you're getting very little additional diversification from the combination. You're mostly just holding the S&P 500 with a small international sleeve. That's fine, but you should know that's what you're doing. What does the valuation data say in 2026? Let me be clear. I am not a fortune teller, and nobody who tells you they know what markets will do over the next 5 years is being straight with you. Anyone who says international is about to explode or S&P 500 is going to crush it again is expressing an opinion, not a fact. What I can tell you is what the data has historically suggested about expected returns based on starting valuations. The US CAPE ratio in early 2026 is elevated relative to history. When you've bought US stocks at similar valuations in the past, 10-year forward returns have averaged somewhere in the 4 to 7% real range. Not bad, but below the historical average. International developed markets, trading at much lower CAPE ratios, have historically delivered higher forward returns from these valuation levels. Vanguard's own research team, and I want to be clear, this is their published research, not mine, has been publishing 10-year forecasts that show meaningfully higher expected returns for international and emerging market equities than for US equities. Their models have consistently projected something like 7 to 11% annualized for international developed markets versus 3 to 6% for US equities over the coming decade. Does that mean you should abandon the S&P 500? No. Does it mean you should be aware that the tailwind you enjoyed over the last decade may not repeat? Absolutely yes. What does the research actually support? Here's the honest answer from the academic and practitioner literature. There is no universally optimal allocation between US and international stocks. But there are some things the research consistently says. 1. Holding only US stocks is a significant concentration bet. You are 4% of the world's population owning stocks in one country. The US is extraordinary. Best capital markets in human history, rule of law, deep liquidity, unmatched innovation. But concentration is concentration. 2. The home country bias that most American investors have is larger than what's rationally defensible. Most Americans hold 80 to 90% US equities. The US represents roughly 60% of global market cap. There's a gap there. 3. The benefits of international diversification are most visible during prolonged US underperformance, which by definition you don't see coming. They're insurance, and insurance never seems worth it until it is. 4. Rebalancing between US and international has historically improved risk-adjusted returns even when one region dramatically outperformed. The act of selling what's up and buying what's down, when done systematically, captures a rebalancing premium over time. The tiered recommendation. Okay, here's where I give you something you can actually act on. If you're under 35 and just starting out, buy VT. Just VT. One fund. Done. You get the entire world's equity market in a single ETF at 0.07%. You don't have to decide between US and international. You own both in market weights. As conditions change globally, the fund adjusts automatically. You're not making a bet on any one country. You are buying capitalism broadly. It is the most intellectually honest and behaviorally simple choice you can make at this stage. Stop overthinking it. If you insist on separate funds, because your 401k doesn't offer VT, use a mix of roughly 60 to 70% S&P 500 fund and 30 to 40% international index fund. That roughly replicates what VT does. If you're 35 to 45 and already have a meaningful portfolio, this is where it gets more interesting. If you're currently 100% S&P 500, I genuinely encourage you to consider adding international exposure. Not because I know it will outperform, but because you want to stress test your portfolio. Can you sit through a decade where the US lags? Do you have the conviction to hold if that happens? A reasonable target is 70% US large cap, 20% international developed, 10% emerging markets. You can build that with 3 funds. It's simple, it's defensible, and it means you have a real answer when someone asks why you own what you own. Don't do this all at once if your current portfolio is large. Use new contributions to shift the allocation over 12 to 18 months. No need to create a taxable event by selling everything and rebalancing in a taxable account. If you're over 45 and thinking about sequence of returns risk, your primary concern at this stage is volatility management, not maximizing expected return. International equities can be more volatile than domestic, particularly emerging markets. I'd be more conservative here. Maybe 75 to 80% US, 15 to 20% international developed, and little to no emerging markets exposure. You don't need the extra potential upside if it comes with extra potential downside at the wrong time. The closer you are to needing this money, the more you want boring and reliable over theoretically optimized. The one thing everyone should do, regardless of their age, write down why you own what you own. Seriously, one paragraph. I own 70% S&P 500 and 30% international because I believe the US will remain the dominant equity market, but I want exposure to cheaper international valuations as a hedge against a decade of US underperformance. Something like that. Read it the next time markets drop 25%. It will save you from yourself. A note on what you should not do. Don't try to time this. Don't go 100% international because valuations look better today. Don't chase last decade's winner. Don't make dramatic allocation changes based on headlines or YouTube videos, including this one. The point is to build a portfolio you understand, that matches your actual risk tolerance, and that you can hold through anything. A slightly suboptimal portfolio that you hold through every market cycle will outperform an optimized portfolio that you panic sell every time things get scary. Boring wins, consistency wins, understanding what you own wins. I want to take you back to that moment at the beginning. You, late at night, staring at your app, second-guessing the fund you bought because someone told you to. Here's what's different now. You know what's actually inside each option. You know the overlap. You know what the valuation data is saying about forward-looking returns in 2026. Not historical returns, but the numbers that actually matter for the money you're putting in today. You have a framework that accounts for your age, your situation, your actual risk tolerance. You're not going to sleep tonight because I told you the right answer. The truth is, there isn't one clean right answer. And anyone who tells you otherwise is either oversimplifying or trying to sell you something. What you have now is something more useful than certainty. You have conviction. You know why you own what you own. You can defend it. You can hold it when things get ugly. And things will get ugly. Markets always do at some point. Certainty isn't available in investing. It never is. But confidence, a framework, an allocation you actually understand, that's yours now. So close the app. Put the phone down. And remember this. The best investment isn't the one that performs best in a spreadsheet. It's the one you'll actually hold when everything feels like it's falling apart. Good night.